Good evening. It's Tuesday, January 7th, 2026, and in the last 24 hours, 5 things happened simultaneously that, when you connect the dots, signal we've entered a different market regime entirely. Silver just closed above $80 for the first time in history. The U.S. government seized control of Venezuela's oil reserves while simultaneously capturing a Russian tanker in international waters. Job openings in America dropped 450,000 in a single month, the second lowest reading in 5 years. Goldman Sachs just told their clients to load up on Chinese stocks with a 20% upside target. And Bitcoin, after spending weeks in a range, suddenly found support at $92,000 with institutional flows returning. None of these events are isolated, they're connected. And by the time we're done tonight, you're going to understand why the old playbook, the one that worked for the last decade, stopped working yesterday. Let's start with what happened in Caracas. At 2 p.m. Eastern yesterday, President Trump posted on Truth Social that Venezuela, his interim government, would be turning over between 30 and 50 million barrels of high-quality, sanctioned oil to the United States. Not selling, turning over. He then added something that should make every oil trader, every real estate investor, and every bondholder pay very close attention. That money will be controlled by me, as President of the United States of America, to ensure it is used to benefit the people of Venezuela and the United States. Let me translate that from political language into market language. The United States just unilaterally seized control of approximately $2.8 billion worth of oil, based on current WTI pricing at $56 per barrel from a sovereign nation, and the president personally declared he would control the proceeds. Now, here's where this gets interesting. Energy Secretary Chris Wright announced these oil sales would continue indefinitely, not as a one-time transfer. The U.S. is planning to meet with Chevron, ExxonMobil, and ConocoPhillips this Friday to discuss making significant investments in Venezuela's oil sector. Venezuela has the world's largest proven oil reserves, 303 billion barrels. To put that in perspective, Saudi Arabia has 267 billion. But Venezuela's production has collapsed from 3 million barrels per day in the 1990s to barely 1 million today due to decades of mismanagement and sanctions. Industry estimates suggest it would take $110 billion and 10 to 15 years to rebuild Venezuela's production capacity. Here's the speculation part, and this is where we start connecting dots. If Trump can capture a sitting president, seize the country's oil production, and announce indefinite control over the proceeds, what is stopping him from doing the same in other resource-rich regions where U.S. national interests are at stake? Prediction markets on Kalshi immediately responded. The odds that Trump will take back the Panama Canal jumped from 28% to 37% overnight. The probability of U.S. control over any part of Greenland rose to 38%. These aren't conspiracy theories. These are betting markets where people are risking actual money on geopolitical outcomes. The immediate market reaction? Crude oil futures dropped 1.6% at the open to $56.39. Refinery stocks, Valero Energy and Marathon Petroleum, jumped 4% and 1% respectively, on the assumption they all get access to discounted Venezuelan heavy crude. But here's what nobody's talking about yet, the currency implications. If the U.S. can simply declare control over foreign assets without formal annexation or purchase agreements, what does that do to the petrodollar system? What happens to Treasury demand if foreign governments decide they can't trust dollar-denominated reserves because the U.S. might unilaterally seize them? Keep that question in your mind. We're coming back to it. While everyone was focused on Venezuela yesterday, silver did something it's never done in 5,000 years of monetary history. It closed above $80 per ounce. Not an intraday spike, not a flash trade. A legitimate end-of-day settlement above $80. Let me give you the numbers. Silver opened Monday at 76.54 hours. It closed Tuesday at 80.25, up 3.85 on the day. For context, silver started 2025 at around $30. That's a 167% gain in 12 months. Gold, which everyone considers the safe precious metal, is up 66% over the same period. The S&P 500 up 23%. Now, here's where most financial media gets this story completely wrong. They're calling this a bubble. They're comparing it to 2011 when silver hit $50 and then crashed. They're saying retail investors are piling in at the top, chasing momentum. That analysis is backward. This isn't a retail-driven mania. This is an industrial shortage being masked by paper price suppression, until now, when the physical market finally decoupled from the futures market. Here are the facts. According to the Silver Institute, 2025 marked the 5th consecutive year where global silver demand exceeded mine production. The annual deficit was 117 million ounces. To put that in context, that's more silver than Mexico, the world's largest producer, mines in an entire year. Why the deficit? 3 reasons, and all 3 are accelerating in 2026. First, solar panels. The shift to TOPCon solar cells, which are more efficient but require 30 to 50% more silver per panel, has exploded demand. China produced 400 gigawatts of solar capacity in 2025. At roughly 15-20 grams of silver per panel, that's 60 to 80 million ounces consumed by solar alone. And China just announced they're targeting 600 gigawatts in 2026. Second, electric vehicles. Each EV contains approximately 30 grams of silver in battery components, sensors, and charging infrastructure. Global EV production hit 14 million units in 2025. That's 420 million grams, or 13.5 million ounces, just for automotive applications. Third, AI data centers. This is the one nobody's talking about yet. NVIDIA's new Vera Rubin superchip system, announced yesterday at CES, uses liquid cooling systems that rely heavily on silver for thermal conductivity. Jensen Huang said demand for the H200 chip is very high in China. Every one of these data centers being built to run AI models requires tens of thousands of ounces of silver for wiring, servers, and cooling systems. Now, here's the speculation that could send silver to $150 by year end. China controls 60-70% of global refined silver supply. On January 1st, they implemented export restrictions requiring government licenses. Only 44 companies were approved. The threshold? 80 tons of annual production capacity and $30 million in credit lines. China is doing to silver what they did to rare earth elements in 2010. They are weaponizing control over a critical industrial metal. And just like rare earths spiked 500% when China cut exports, silver could follow the same trajectory if Western countries can't secure alternative supply chains. Right now, silver in Shanghai is trading at an $8 per ounce premium over New York spot prices. That arbitrage gap should be impossible. It exists because physical buyers in China are willing to pay $88 for metal that paper contracts say is worth 80. When arbitrage spreads like that, it means one of two things. Either futures are wrong or physical is unavailable. In this case, it's both. For investors over 40 who remember 2011, you're probably thinking, I got burned once. Why should I believe this time is different? Fair question. Here's why 2026 isn't 2011. In 2011, silver demand was 70% investment driven. Hedge funds and retail speculators bid up the price. When sentiment shifted, they sold, and silver crashed from $50 to $18 in 8 weeks. In 2026, demand is 75% industrial and non-discretionary. Solar companies can't stop building panels. EV manufacturers can't stop producing cars. Data center operators can't shut down AI infrastructure. The demand isn't sentiment-driven, it's structural. That's the difference. Before we go deeper into the macro connections here, if you're finding value in this analysis, and especially if you're realizing these dots aren't being connected anywhere else, do me a favor. Hit the like button and subscribe to the channel. This kind of research takes significant time, and the algorithm rewards engagement. More importantly, share this with anyone in your network who's trying to understand what's actually happening in markets right now, not just what CNBC tells them happened. We're about to talk about what yesterday's job numbers reveal about the real economy, why Goldman Sachs is suddenly bullish on China, and how Bitcoin's quiet recovery could signal a massive rotation in institutional capital. Let's continue. At 10 a.m. Eastern yesterday morning, the Bureau of Labor Statistics released the Job Openings and Labor Turnover Survey, JOLTS data, for November 2025. The headline number, 7.146 million job openings. That's 303,000 fewer openings than October. More importantly, it came in well below economist expectations of 7.6 million. It's the second lowest reading in 5 years, exceeded only by September 2024. Now, if you just read that and thought, okay, the labor market is cooling slightly, you're missing the bigger picture. Let me show you what's really happening beneath the surface. Job openings peaked at 12 million in March 2022. We're now at 7.1 million. That's a 41% decline. But here's the critical detail. Hires remained flat at 5.1 million. Layoffs? Also flat at 1.7 million. Quits? Still at 3.2 million. Do you see the problem? As businesses are posting dramatically fewer job openings, but they're not firing people. They're not seeing mass resignations. This is what economists call a low hire, low fire labor market. Companies are hoarding workers even though they're not expanding. Why does this matter for your portfolio? Because it signals stagflation risk. Economic growth is positive. GDP in Q3 2025 came in at 4.2% annualized, but businesses aren't hiring to meet that growth. They're managing productivity through technology, automation, and overtime rather than adding headcount. That creates a paradox. Strong GDP growth usually means strong earnings growth, which supports higher stock valuations. But if companies aren't hiring, wage growth stalls. If wage growth stalls, consumer spending eventually weakens. And if consumer spending, which is 70% of US GDP, weakens, those strong earnings forecasts evaporate. The market hasn't priced this in yet. The S&P 500 closed at a record high of 6,144 yesterday. The Dow Jones hit 49,462, also an all-time high. Investors are celebrating strong corporate profits, but they're ignoring the fact that those profits are being generated by a smaller workforce squeezing out more productivity, not by healthy economic expansion. Here's the speculation I want to plant in your mind. What if we're in the late stages of a productivity boom driven by AI and automation, where corporate profits keep rising, but employment opportunities, and therefore wealth distribution, stagnate? What if the S&P 500 goes to 8,000 while unemployment goes to 6%? That scenario has a name. It's called a jobless expansion. And historically, jobless expansions don't end with soft landings. They end with demand shocks. Because eventually, if people don't have incomes, they can't buy the products these profitable companies are selling. The Fed is watching this data very closely. Right now, the CME FedWatch tool shows an 82% probability the Fed holds rates steady at their January meeting, only 18% chance of a cut. But if job openings keep falling and hiring doesn't accelerate, the Fed will be forced to cut rates aggressively to prevent a recession. And here's where we tie back to Venezuela, silver, and everything else we've discussed. If the Fed cuts rates while commodity prices are spiking, remember, silver at $80, oil potentially disrupted by geopolitical chaos, you get inflation and unemployment rising simultaneously. That's textbook stagflation. The last time that happened was the 1970s, and it destroyed bond portfolios, crushed real estate values, and turned gold and silver into the only assets that preserved purchasing power. Now let's talk about the headline that nobody's connecting to the broader narrative. Yesterday, Goldman Sachs published a research note forecasting that Chinese stocks would rise 20% by the end of 2026. Specifically, they're targeting the MSCI China Index at 100 and the CSI 300 at 5,200. On the surface, this seems like standard investment bank optimism, but look at the timing. Look at what else happened in the last 72 hours. On Saturday, the U.S. launched a military operation in Venezuela. On Sunday, China's foreign ministry issued a statement calling Trump's demand for exclusive access to Venezuelan oil a typical act of bullying. On Monday, the U.S. Navy seized a Russian-flagged oil tanker in the Atlantic that was transporting Venezuelan crude. And yesterday, Goldman Sachs told their clients to buy Chinese equities. Let me connect these dots with a speculative thesis that makes sense when you look at the chessboard from 30,000 feet. China is the world's largest importer of crude oil. They import roughly 11 million barrels per day. Venezuela was one of their key suppliers under sanctions-busting agreements. With the U.S. now controlling Venezuelan oil and selectively rolling back sanctions to benefit American refiners, China's energy security just took a hit. How does China respond? They don't escalate militarily, that's too risky. Instead, they accelerate their de-dollarization strategy and double down on domestic growth. And that's exactly what we're seeing. Goldman's research note explicitly states that China's equity gains in 2026 will be almost entirely earnings-driven, supported by AI adoption, export diversification, and what they call anti-involution policy, basically preventing destructive price competition that erodes profit margins. Let's unpack the mechanics behind Goldman's bullish call. The market internals are already heating up. The CSI 300 surged 3.5% in the first week of 2026, reaching a 4-year peak. We're seeing the highest trading turnover since September, and margin debt is flirting with record highs. The expectation? Foreign capital, which has been underweight China for years, is projected to pour $10 billion back into these markets to chase the momentum. The fundamental argument rests on a massive earnings recovery. Goldman sees corporate profit growth jumping from a sluggish 4% in 2025 to a robust 14% over the next 2 years. Yes, this is driven by AI adoption and global expansion from giants like BYD and Xiaomi. But here's the silent thesis, the angle the analysts aren't saying out loud. With China's energy security compromised by the U.S. moves in Venezuela, their only option is to sprint toward total energy autonomy. That means an aggressive build-out of nuclear, solar, and battery infrastructure. And that infrastructure is built out of silver, lithium, and copper. So when you see a buy rating on Chinese equities, read between the lines, it, as a derivative bet on China, is forced march toward resource independence. It fits perfectly with the supply crunches we discussed earlier. Now shift your attention to a signal that got buried under the geopolitical noise. Bitcoin reclaimed $91,893 yesterday. For context, we were trading near $83,000 just 2 weeks ago. But the price action is secondary to the flow data. Spot Bitcoin ETFs absorbed a staggering $1.2 billion in net inflows during the first 2 trading days of 2026 alone. This isn't retail FOMO, this is institutional allocation. Bernstein analysts just released a note confirming their view that the crypto market has officially bottomed. Why is this happening now? Look at the macro backdrop. 10-year Treasury yields are sitting at 4.6%, offering little protection against rising inflation expectations. Capital is fleeing to scarcity. Gold is near $4,500, silver is vertical, and Bitcoin is waking up. Bernstein is now targeting $150,000 per coin by year end, driven by a specific catalyst: silent liquidity expansion. The Fed is engaging in reserve management purchases, effectively injecting $40 billion this month, while the Treasury draws down its general account. When you combine fresh liquidity with the threat of asset seizures, the case for a decentralized capped supply asset becomes mathematically undeniable. But here's the really interesting development. Altcoin season appears to be starting. Ethereum is up 10% in the last week, double Bitcoin's gains. Chainlink just got approved for a spot ETF by the SEC via Bitwise. Bitcoin dominance is dropping from 61% to 58%, which historically signals capital rotation from Bitcoin into higher risk, higher reward altcoins. Why does that matter for traditional investors who don't care about crypto? Because altcoin season typically coincides with risk-on sentiment in broader markets. It means investors are willing to take leveraged bets on speculative assets. That usually happens when they believe central banks are about to ease policy or when they're front-running liquidity injections. If the Fed is quietly expanding its balance sheet, even if they won't call it QE, and if Bitcoin and altcoins are responding by rallying, that's a leading indicator for inflation-sensitive assets across the board. Commodities, real estate, precious metals, and yes, even meme stocks tend to perform well in these environments. Let's bring this full circle. We started with 5 seemingly disconnected events in the last 24 hours. U.S. seizure of Venezuelan oil and control over proceeds. Silver closing above $80 for the first time in history. Job openings falling to 7.1 million, signaling labor market weakness. Goldman Sachs forecasting 20% upside for Chinese stocks. Bitcoin recovering to $92,000 with institutional inflows returning. When you connect the dots, here's the narrative that emerges. We are transitioning from a globalized dollar-centric system where financial assets, stocks, bonds, currencies, dominated returns to a multipolar world where physical assets, commodities, real estate hard currencies like gold and silver provide protection against currency debasement and geopolitical instability. The U.S. is asserting resource control through direct military action rather than market transactions. That undermines trust in dollar-based reserve systems. China is responding by building economic independence, which requires massive commodity consumption. Both dynamics are inflationary for physical assets. Simultaneously, labor markets in the West are stagnating, which creates a ceiling on consumer spending growth that limits upside for traditional equities unless they can maintain profit margins through automation, which, ironically, requires massive amounts of silver, copper, and rare earths for the technology infrastructure. So what do you do with this information? If you're a traditional 60-40 portfolio investor, 60% stocks, 40% bonds, you need to seriously consider reducing bond exposure. Bonds performed terribly in 2022 when inflation spiked. They'll perform terribly again if we enter stagflation. Reallocate 10-15% of that bond allocation into hard assets. Specifically, consider exposure to silver miners like Wheaton Precious Metals or Endeavor Silver. These stocks move 3-5x the underlying metal price due to operating leverage. If silver goes from $80 to $100, mining stocks could double. Consider energy infrastructure. If the U.S. is rebuilding Venezuela's oil sector, companies like Schlumberger and Halliburton benefit from the engineering and equipment contracts. Refiners like Valero are already up 4% on the news. Consider Chinese tech exposure with caution. Goldman's 20% target assumes smooth policy support and no major trade war escalation. If Trump follows through on 60% tariffs, that thesis breaks. But if China succeeds in its AI build-out, companies like Tencent, Alibaba, and BYD could see massive earnings growth. Do not chase Bitcoin at $92,000 if you're not already positioned. Wait for a pullback to the $85,000 support level. But if you're underweight crypto entirely, allocating 2 to 5% of your portfolio makes sense in a world where central banks are debasing currencies and governments are seizing assets. And finally, and this is the most important point, start thinking about portfolio construction in terms of what protects me if the system we've known for 50 years stops working. That means physical assets you can hold, businesses that produce essential goods, and exposure to countries that aren't dependent on the dollar system. We opened this video by saying that in the last 24 hours, 5 things happened that signal a regime change in markets. Let me leave you with one final thought. The last time we saw simultaneous resource seizures, industrial commodity shortages, labor market stagnation, and aggressive central bank liquidity expansion was the 1970s. That decade destroyed traditional 60-40 portfolios. Real returns on the S&P 500 from 1970 to 1980 were negative. Bonds lost purchasing power. But gold went from 35 to 850. Silver went from 1.50 to $50. I'm not saying we're about to repeat the 1970s exactly, but I am saying that the playbook that worked from 2010 to 2020, buy stocks, hold bonds, ignore commodities, is not going to work in 2026. The market just told you that yesterday. The question is, are you listening? If you found this analysis valuable, I'll be tracking these developments closely. Subscribe to stay ahead of the narrative. I'll see you in the next one.